Good evening, everyone. Welcome to Quantum Mutual Funds 2022 first webinar on this year. The webinar is on right asset allocation. I'm Sandeep Bosley. I head the customer interaction team at Quantum Mutual Fund. We have with us today Chirag. Chirag had joined us in 2006. Most of you must be knowing Chirag, or you must have attended our Path to Profits or a webinar before. Currently, he manages around 5 funds, largely in the field of alternative investments. That includes both quantum gold fund, multi-asset fund of funds, equity fund of funds, and the ESG fund. Now, Chirag has more than around 18 years of experience. He also specializes in the field of alternative investments. Yeah. So we'll have a presentation around for 40-45 minutes. You can type your questions in the chat box. We'll try to take most of the questions for you. If any questions are unanswered, you can definitely write to us. We will surely get back to you. And also we'll try to have a 40-45 minutes question in half an hour session after that on all the question answers. We may club some questions which may be duplicate or repetitive in nature for that. So over to you, Chirag.
Thank you, Sandeep, and thank you everyone for joining us today. It's kind of our first webinar for 2022, and we thought that nothing better than start with asset allocation, because the role that asset allocation plays in one's portfolio in shaping up the long-term returns that you generate to meet your goals, it is very, very essential to start with that. And with the new resolutions of better investing, I think this could be a great start to the new year. So wishing everyone a great new year, and hope you are doing well from a health perspective. And we hope that everyone has a more fulfilling and much better new year going ahead. So there is a lot of uncertainty, like we are seeing again a COVID wave hit us now. It's been raging significantly, the numbers are sharply rising. And COVID was one thing which was, has stuck us and caught us unguarded in a way. So there could be many instances, and we have seen many instances in the past that were kind of uncertain. We were not prepared for it, or we didn't even anticipate it, but it kind of come and hit our portfolios. And how do we navigate such times? How do we kind of navigate and be prepared for all such kind of instances? Is there a magic formula? Can you do it yourself? Can you rely on solutions? So we'll talk about those magic formulas that everyone is searching for. There is very, very simple and a certain magic formula that has worked for years together for many of our investors. Today we'll share that as well with you. But let's set some context. Let's look at the current scenario, where we are poised. How is 2022 likely to be? So if you look at this was a survey done by Bloomberg, where they kind of looked at professionals, market professionals, 800 of them, and asked them what are the greatest fears for 2022. And collating all of that, it became more than 100 factors. So there are so many things going on around in the global world that if you take a combination of views of so many people, there are likely more than 100 things that you need to ensure that you are known about, and therefore you're ready for dealing with them. So we have always heard these kind of things like COVID has been there for 2 years, inflation is raging up. There is a change in policies from the Federal Reserve and central banks otherwise globally. So there is a lot of things a lot of moving parts around. And I think it is easier than said to navigate these kind of uncertainties. And it's not only now. I think uncertainty is the only uncertainty. It's the only certainty in markets, right? If you look at so many episodes that have come and gone, right from 1980s till now, time and again, there are many episodes, some crisis, some collapse into like the tech bubble that we saw in 2000s. Or if you look at certain of these factors were predictable, but many of those were very unpredictable, like SARS in 2003 or COVID in 2020. These were something that one couldn't predict, or 9/11 in 2001. These were some things, if it is financial led, you kind of, it takes time to build that bubble and for the bubble to collapse. And many of the experts could see it coming and be prepared for it. but some of them are really something you are kind of caught unguarded. You never thought it will happen, but it happens. So there has to be a portfolio setup which is helpful in navigating through these known and unknown risk or uncertainty that we see in markets or in markets generally. Also, we have seen asset markets move in cycles, right? There have been cycles for each and every market, and to predict which asset will do better next year is certainly a guess rather than a certainty, because of these uncertainties, known and unknown, that can come and hit us. And therefore, to say with certainty which asset market will do well in the next year, it's very, very difficult. But yeah, I mean, one thing is given that, at some point in time, one of the asset classes will be at the top, right? So to have your money spread across assets, so that you have a chance of participating in a market which is going to be the next big market for next year, is very, very essential. And that's simply known as asset allocation, nothing more than that. Coming to 2022, probably there are three big scenarios that could play out. Again, there is no certainty, but there is likelihood of one of these scenarios playing out in the next year. Something is given, right? We have seen inflation pick up significantly across the globe. It is result of two things. One is that we have seen so much money being printed, about $12 trillion being printed by central banks globally. That is too much liquidity sloshing around. And second is because of COVID hitting supply chains, there is also a bout of inflation. So that supply chain issue will get normalized over a period of time, but the liquidity sloshing around will take some time. And this liquidity has trickled down in the real economy. And that is why we are seeing inflation as opposed to the period of 2008 to 2010, 11, where there was so much money being printed, but there was not much inflation. Because money remained in financial circles. It did not go down to real economy. But this time, money printed by central banks has seeped in the real economy because there were handouts by governments in US, Europe, etc. And so that is leading to inflation. So normalize, because to fight the inflation menace, it is raging big time. Central banks are compelled to tighten their monetary policy. To the easy money policy that they were running so far, they're saying that we will stop printing much money. That going ahead, we will and we will look at unwinding the balance sheet that has become so big, and we will look at raising interest rates. These are the things that they are talking about in terms of policy now. And this is nothing but they have gone so low in their easy money policy that rates are close to zero. There is so much money they were printing. So there has to be some normalization someday. And this inflation is forcing them to do much more aggressively than what they would have liked in terms of time frame. So in the scenario one, we are talking about normalization of global and Indian monetary policy. If it is slow, it is gradual, they don't impact growth significantly, then you will anticipate that equities would do well. Debt may not do so well. Gold may also not do so well, because it is a scenario where inflation doesn't move higher further and central banks go slow and steady on the monetary policy. And therefore, gold may also not do so well because of inflation remaining and they might be slow. So real interest rates will take time to pick up. So gold may be a neutralish kind of scenario, but equities in that scenario could be positive. Second scenario, if inflation starts moving higher further from here, then they will be forced to become more aggressive, more hawkish in their monetary policy. They will have to unwind their balance sheet faster. They will have to raise interest rates faster. In that kind of scenario, again, equities and debt may not do so well. Gold, to an extent, will still be a better asset to hold in such times because real interest rates will still catch up, because they can be aggressive to an extent, but inflation just keeps spiraling and goes out of control. Then gold is a likely asset where reasonably will do well in the scenario two, as opposed to equities and debt. And coming to scenario three, where we are talking about growth collapsing. If growth collapse because of, say, another COVID shock, or monetary policy remains accommodative, but inflation kind of surges, that kind of kills growth because of the inflationary pressures within the economy, demand collapses, then equities will generally be not the asset class to hold on to. It will not do as well as what debt and gold would do. So again, three scenarios. What will pan out is very, very difficult to say. Probably somewhere around normalization is a given, but how fast it becomes, how it impacts growth is something that we need to wait and watch, and we will kind of continue to guide you in terms of how we see it shaping up going forward. So what is the asset class that you will bank on next year? Equities, fixed income, or gold? How do you pick that winning asset class? Should you try and predict where should I put the money for next year? Or should you have an asset allocation approach? Let's look at getting answers from data, right? Generally, as an investor, what we focus on, we kind of look at various noises that remain in the global markets. We look at how the macroeconomic policy is shaping up, how the market cycles, which is the best performing asset class next year, where will I get maximum returns? That is all we kind of always keep looking at, which is usually outside our control. We are just trying to follow data, and we are trying to see what trends are shaping up, right? But one thing, irrespective of the trend shaping up, one thing that always helps you is asset allocation. Because you may be prepared for something, but something else happens. There is an uncertainty like COVID struck global markets, and therefore your portfolio takes a hit. But if you are allocated well across asset markets, then you need not worry. All these will keep happening. They have kept happening over for several years. But if you are well allocated across asset class, you will have a piece of asset in the winning asset class for sure. And that will help you generate the returns that you're looking to meet your financial goals. So always remember, irrespective of what scenario is likely to shape up, there is a role for each and every asset class in your portfolio. Remember, uncertainty can strike from anywhere. And therefore, which asset will be useful in that kind of scenario is really unpredictable, because you don't know the scenario itself. And therefore, each asset will play a role in different kind of scenarios. Equity over the long term, it's one of the best asset class to generate long-term growth, but at the same time, it is prone with risk, right? Though over a period of time, we have seen that it will help you generate the returns that you're looking for, but there could be risk which could knock equities down by 30, 40, 50% in any given year, right? Are you ready to absorb that kind of risk, that kind of drawdown on your portfolio? If not, then you need those two other asset classes to balance out, right? Debt is there for stability in your portfolio, and gold is the best available diversification tool for your portfolio. So you mix all three in a proportion that will help you sail any kind of market environment, be it high growth, be it low growth, be it any kind of uncertainty you're seeing. You're well protected from those. And why asset allocation? Studies have shown and proven that 90% of the variability in returns from portfolios comes from asset allocation decisions. The other things like market timing, selection of security, etc., just impacts 10% of the variation of returns. So 90% is determining much of how your returns will be, and 10%, where we generally focus on, determines very, very little. So focus on that 90% that will lead to a better result, rather than that 10% which will not yield much rather it just gives you stress, rather than that 90% will give you peaceful sleep at night. So if you look at asset allocation, when you're trying to do that asset allocation, there are various biases that you come across. Very importantly, herd mentality. You try to do what everyone else is doing. And that's most of the time a very, very wrong decision. There is also called as recency bias. We look at recent returns and kind of trying to chase that. And that is one of the very big mistakes, again, that investors end up doing, because what has really played out in last 1-3 years is unlikely to be repeated over the next 1-3 years, right? So when you're looking at decision making, don't get biased by the recent returns that that asset class has generated. Look at an overall scenario. Am I overexposed to that asset class because that asset class has done well over the last 1-3 years? Then it's time to kind of book profits and move to the other asset class and rebalance your portfolio, right? So there are various biases out there which we are kind of prone to when we take decisions of investment. Rather have a bigger approach, a very top-down approach, and say that I have to be in this asset class, and this asset class has become significantly larger, and now I have to move out of it. It's similar to that rubber band theory, right? When you stretch a rubber band, there's a limit to which you can stretch it, and then it comes back. Similarly, you have to have that approach in your portfolio, that only to an extent I can leverage this asset class. I mean, bank on this asset class, and it become a higher proportion. I need to bring it back to its original position. 2020 was a great reminder of why asset allocation is important. In time and again, crisis teaches us a lesson to kind of have a broad asset allocation. Be it the 2008 financial crisis, when equities fell by more than 50%. 2020, in that just 1 month, equities fell by 30-40%. And if you look at that quarter of first quarter of 2020, equities had over minus 28%. So if you're only in equities, are you ready to take 20, 30, 40% knock, or rather be in an asset class like 40% equity, 40% debt, 20% gold, very well diversified, which would have fallen only by 8% in that quarter? So this is more kind of risk that you're ready to take rather than the risk that you're unwilling to take. And that is what gets rationalized by asset allocation. Again, if you look at very long term, since 2004 till now, we have seen various cycles in markets. And across cycles, if you look at, equities have generated a return of 13%. And the biggest fall that equities took from top to bottom was in 2008 financial crisis of minus 56%. Equities fell by 56% in that period. Whereas if you had a portfolio of equity, debt, and gold, which has generated slightly lower returns at equities. Now, again, we are at peak peak returns in equities. Equities are at peak right now. And despite that, you are earning just about 2% lower returns. But at the same time, look at the risk, the volatility, the up and down movements has come down from 21% to 9%. And the biggest fall that you have seen reduces from 56% to 21%. So on a risk adjusted basis, which is measured by the Sharpe ratio, is much higher in a diversified portfolio as opposed to in single asset like equities. So you have to balance out the risk and return that you're trying to generate, so that you have a smoother ride and you're not overtly worried when there is a sharp fall in markets. So you of course, with asset allocation, you compromise on returns a bit, but at the same time, you're taking very, very significantly lower risk than a single asset class. Again, in this scenario, how do you position when FD rates are going down? Bulk of the money still investors have with fixed deposits, and it's not in a good situation where FD rates have secularly gone down, and they are at one of the lowest points that we have seen. In such kind of times, should you still bank on FDs, or there are better ways to do it? So if you look at this slide, which most of you would be aware that fixed deposits have been a losing proposition overall. So if you look at fixed deposits, they have generated about 6% return since a very long time frame, that is after tax. And if you were to look at a consumption basket, we all have a basket of spending, and what that basket was about 24,000 rupees a year for a family in 1990 has increased to about 4,27,000 rupees This is a typical consumption basket. Of course, everyone will have a higher or lower spending basket, but this is a typical things that we all spend on, like clothing, rent, electricity, footwear, etc., going out, entertainment. So most of us will have a higher spending, but still on an average basis in the economy, average spending basket is about 4,27,000 rupees today for a family. And this has increased by about 10% a year. Every year, like a rickshaw or taxi meter, this keeps ticking higher, and it is ticking at a pace of 10.1% per annum. If you were if you were invested in gold, which was about 3,400 rupees per 10 grams in 1990, it is closer to 48, 49, 50,000 rupees in that zone on an average basis in 2020. So if you look at that, has increased by about 9.4%, nearly matching that spending increase in basket. Of course, the spending increase is a kind of a real increase as opposed to official numbers of CPI, consumption, consumer price inflation, etc. But with this real, it is kind of still matching very close. And gold, if it kind of runs up a bit from here, I think it will really match the spending, and that is what gold has done. It kind of stores value. It can give you over a long-term returns very close to what inflation will give you. So it kind of protects your consumption basket increase. Again, coming to equities, one unit was about 730. Sensex was at 730 in 1990s. Today it is 47,000. It has gone much higher, but in 2020 it was 47,000. So it has increased by nearly 15%. So it is much higher than the spending increase that we have seen, and therefore has helped in increasing our standards of living. So this is one asset class you can bank on really well to ensure that the money works more than the increase in spending, and therefore you have a real saving with you, and that helps you to improve your standard of living. So equities is the asset class which should be a bulk of your asset within your portfolio. Plus you need to have stability and some diversification to help you have a smoother ride. So when it comes to asset allocation, of course, equities have done really well. It has to be a bigger thing, but within an asset allocation, what should you do? There are two ways to go about it. There is a ready one-stop solution available by funds, and there is something called do it yourself, that you can shape up your own asset allocation. So solutions like the quantum multi-asset fund is available, which helps you generate a steady return that could help you generate better returns in your fixed deposit. So if you are trying to move out of your fixed deposit, that could be a place for you. Or you could say that so far what I have banked on fixed deposit and it doesn't work for me, I should really move towards an asset allocation that works for me over a long period of time. Then do it yourself, and a 12-20-80 strategy, which we'll talk about more in detail, is how you can do it. So first, a ready-made solution is the quantum multi-asset fund. It is an unbiased allocation fund which invests across asset markets like equity, debt, and gold. When I say unbiased, is if you have come across many balanced funds out there, they have a minimum 65% allocation to equities. And given they are very lopsided towards equities, they're kind of unbalanced to an extent. And if you are in a fund which is nearly more than 65% at all times, I better be in an equity fund rather than be in a balanced fund. So when you're looking at a solution, you need to ensure that you're going to in a fund which is unbiased, which is not lopsided to a particular asset class. And in this, what we do is risk is very, very important. If there is a risk from a valuation perspective in equity markets, we will be lower allocation to equities. So if you look at from mid 2020s, when markets were had started recovering and moving higher, we kept on reducing our allocation to equities. And for a fairly long time, we were lower allocated to equities. It's only now we have kind of slightly increased our allocation in December, when markets gave a sharp correction of about 10% or so, and gave us an opportunity to slightly increase the allocation. But if there is a risk, we will stay put and we will be lower allocation to equities. But if there is an opportunity like March 2020, when in a single month we went from 25% allocation to equities to 50% allocation to equities, as valuations became really better on a relative, on an absolute basis, and we kind of increase that allocation. Our endeavor is to give you a better return than your fixed deposit while taking minimal risk to do it. The chart on the right hand side is a comparison with the fixed deposit. 90% of the time, the quantum multi-asset fund would have done better than a fixed deposit. And if you look at the blue line, there's a significant gap between, this is a 3-year rolling period returns for the fund, the benchmark, and the fixed deposit. And if you look at only the fall that we saw in March 2020 or 2015, wherein we had slipped below that FD line, but again recovered very sharply. So at most of the times, you'll get a better return than your fixed deposit on a 3-year basis. And on a 3-year basis, it becomes efficient at tax as well. It's 20% with indexation. So your tax comes to about somewhere between 8 to 12% in that range. So much lower if you're in a 30% bracket. So this is one way, which is a ready solution for you. You can be in this fund, I think, but rather better, do it yourself with a 12-20-80 strategy. We have seen this work across time horizons, across kind of cycles, be it the global financial crisis, be it the COVID crisis. It has emerged stronger and victorious in each of those phases. And therefore, it gives us confidence to have seen market cycles and see it working. We kind of say that this could be a magical formula that you were searching for. It is a 12-20-80 solution. What it means is 12 months worth of your monthly expenses should be parked in a very safe place, be it a liquid fund which does not take risk, be it a State Bank of India fixed deposit, any place where you think there is no risk to that money, it should be there. So 12 months of safe money, and whatever money is left could be split between 80 to equities and 20 to gold in that proportion. And when you look at gold, 20%, it has to be the efficient choice like the gold fund of funds or the gold ETF. And when you have that 80% equities, which is a big chunk, that has to be diversified across styles of equity management. It cannot be just one fund or two funds. It has to be several styles, because that's a big chunk of money, and that cannot be dependent on one particular style, because we have seen cycles for certain styles, and therefore you have to be very, very diversified with that allocation as well. So what we suggest that 80%, whatever that amount comes to, 70% of that amount goes into quantum equity fund of funds, which is a bouquet of funds, diversified equity funds that is managed by external fund houses. So it goes to other funds that we research on your behalf and invest in them, and 15% in the ESG fund and 15% in the long-term equity value fund. We'll see each of what role each of these subsets do in a overall context, but there is a role, like you have role for every asset class. Every fund has a role, or every style has a role within the overall scheme of things. So this is what many call as emergency corpus. This has to be very, very safe. The quantum liquid fund does not take a risk on credit exposure, except PSU, very select PSUs it invests into, or it's largely in government securities. So that is the kind of thing, a liquid fund which does not take risk, and therefore that could be that 12 months expenses lying in a quantum liquid fund. Quantum liquid fund will ensure always safety over returns. It has very, very low credit or default risk. There is an insta redemption available up to 50,000 any point in time during the day. Markets open, shut, or markets are or the cutoff times are over. You can still redeem instantaneously 50,000 rupees in your bank account to be spent. That's called as insta redemption. And as I've said, it only invests in highly rated securities like PSU or public sector banks and government and money market instruments. So your 12 months, this number 12 or 24 months or 36 months could depend on how comfortable you are, but 12 months has worked well. And therefore we say that 12 months of safe money has to be there. So that becomes your emergency corpus. Only in times of stress, only in times of stress, be it in your personal lives or in asset markets, you could use this in emergencies. Otherwise, you can easily bank on the other portion of your portfolio, that's 80-20. Coming to the big chunk of your portfolio, the 80% block, which has to be diversified in different styles of management. 15% of that has to be the long-term equity fund. You have known that it's a value-oriented fund. It has a big track record of 15 years. It also focuses on reducing risk. We have seen time and again when markets have become frothy, it has not participated in such markets and have been patient, and cash in those times have increased, that protected the downsides when it has resulted. And when there is an opportunity, when markets are rational, it gives you, a good 2-3 year or 5-year opportunity. It has gone ahead and participated, and cash levels have been as low as 1-2% as well. So it aims to generate that long-term risk-adjusted returns and minimize downturn using that approach of valuation for you. So 15% can be in this value strategy, a value style of investing, which has been true to label, not only now, not only after SEBI classification, but right since its inception in 2006, it has followed and managed within the value style of investing. So if you look at, is it true to label? Even today, it is true to label. If you look at the valuation scenario on a trailing 12-month, it is available at a 39% discount to the index, that is BSE 30. And even if you look at a forward-looking basis, it's still on a 1-year forward basis, 2023 estimates, it is 34% less expensive than the index. So that really truly tells you that it is certainly a value style. It has remained true to label since inception, and this could be a small chunk of your equity allocation, 15% allocation to the long-term equity fund. 15% again to ESG. ESG is kind of a new and emerging concept. We have been looking at this space since 2015 as a group. We have a fund running since July 2019, and it has kind of done better than the indices. And it is coming with a promise of achieving the triple bottom line of planet, people, and profits while ensuring that planet and people are kind of unharmed and move towards more sustainable future. So we have seen that sustainability is a driver of long-term return for this kind of strategy. And we have seen companies that are sustainable that kind of keep doing better over a long period of time, and therefore generate that returns that you're looking for. And be it shocks, like what shocks that we have seen since 1980s or before than that, hit markets. These companies are truly resilient, be it market shocks, be it economic shocks, or be it inflationary shocks. These companies are quality companies and have been resilient and been able to pass on the price increases even in times of stress, and generate long-term profits and returns for investors. So I think ESG is likely to become mainstream. It's happening globally. Even in India, there is a regulatory push. There is a push from consumers. There is a push from investors. The global investors are also incrementally engaging with companies with their sustainability mindset. So I think it's going to be a future of investing. And I think there is enough evidence proving that this kind of investing is working well globally and in India. So 15% allocation to the Quantum India ESG equity fund. And if you look at if you look at today, when we are seeing a pickup in growth momentum, it seems like we are on cusp of an economic growth. It is also poised in the right sectors, like consumer goods is where consumption is likely to increase, or be it autos where the consumption is likely to increase, or be it certain chemical stocks, it is poised in the right buckets right now to take advantage of the future growth that will likely come. So sustainability positioned in a right way, and it is a growth sign kind of investing because it is value agnostic in a way, and banking on sustainability as a driver of return. So you could look at a 15% allocation to this fund, and the bulk of that 80%, 70% of that 80% should be in the quantum equity fund of funds. It's a basket of equity funds. We have 9 equity funds in the portfolio. You don't have to track each and every fund. We do it on your behalf. We research those funds. We try to pick consistent performers rather than picking the top performer at each point in time. Because time and again, we have seen that the top performer today does not remain at the top tomorrow. We have seen that top changing in terms of consistency not being there at the top. And therefore, we are looking for consistency and not the top really. So we invest in schemes, we kind of qualitatively, quantitatively evaluate that, we kind of meet the fund manager, understand their philosophy, see that what they do and what they say is the same thing, they are true to label. And also over a period of time, it also has tax efficiency, because when you buy and sell equity fund, you have to pay tax when you switch equity funds. As a fund, when we switch, we don't have to pay tax. Also, there is an indexation benefit available after 3 years. After 3 years, it becomes 20% with indexation. The tax level comes to between 8 to 12%, depending on the indexation benefit. And overall, largely, this gives you exposure to different styles of management. There are different fund managers adopting different styles, and that gives you the diversification that should be there when your bulk of your money goes into equities. So there are so many schemes out there. You need to build a concentrated 5 to 10 fund portfolio. You need research, you need consistent performance across market cycles, you need funds that also consider risk. You need to avoid portfolio concentration. You need a good mix of large and mid-cap schemes. And for you, it makes it easier. It's a solution for you. And you just have to one fund to invest, one NAV to track, one folio, and you're sorted. So that was the big bucket of equity that occupies 80% of your money after the 12 months. And it should be spread in these 3 buckets, and you're sorted for your equity investment need. You get a value style, you get a sustainable investing style, and you get a mix of styles in form of equity management. Coming to another block, there is 20%. We think that is very, very important to have gold in your portfolio. And a good way is through a gold ETF or a gold saving fund, because virtually it's open 24/7. You can buy and sell at any point in time, and you get efficient prices. It's backed by 24 karat gold. You get the wholesale market efficiency at a retail level. Now the denomination of the ETF is 0.01 grams, so just about 41 rupees. And the gold saving fund is available 500 rupees. So even at that prices, when you buy, you get efficiency of the wholesale market at the retail market. There are no markups. There are no high premiums associated like they are associated with physical gold. You don't have to worry about purity. You don't have to worry about the making charges or safekeeping of that gold. And you can invest in very small denominations. But gold, believe me, it's one of the best diversification tools available today. Time and again, we have seen that when equity markets have fallen, gold has done well. And overall, over a period of time, if you as we saw in that slide, since 1990, it has almost matched the cost of spending increase that we have seen. So it's been true to label as being a store of value for you. So we've already spoken much about the quantum gold ETF or the quantum gold saving fund, where you can do an SIP and invest in that. Also, when you buy and sell physical gold or a digital gold, you lose out on GST, because when you buy, you pay GST. When you sell, you don't get that GST benefit. So there is a differential of 3% already been there when you buy physical gold or digital gold. But when it comes to mutual funds, they are pass-through vehicles. They are GST registered. So when they buy, they pay GST on your behalf. And when they sell, they get that GST offset of the GST that they have paid during the purchase. So overall, it gives you that benefit also of GST offset, which is not available in physical or digital gold offerings. Plus, more importantly, it is a regulated instrument. It is regulated by SEBI as a mutual fund. So that's, I think, an important point to consider when you take exposure to any kind of gold instrument. So coming to this overall overarching theme of 12-80-20, as I've said, it has worked well across time horizons, across market cycles. Equities still will give you a higher return. But again, if you want to minimize the risk, what is that you will kind of okay giving away for the reduction in risk? That is the call that you have to take broadly. And if you look at returns, right, a 20-80 strategy, we're not including a liquid fund return, because liquid fund is just for emergency corpus. I mean, you just don't kind of consider that, because that is only used in emergencies. You don't bank on that return as well. So if you just remove that and just dwell on a 20-80 strategy, which is 20 gold and 80 equities, and here 80 is a portfolio of quantum equity fund of funds, long-term equity fund, and ESG in the proportion of 70-15-15. But because the ESG fund was launched in July 2019, until that time, the 80% was only made of quantum equity fund of funds and long-term equity fund in the ratio of 80-20. And if you look at the 10-year return, it is close to 14%, very closer to what equities have given. But at the same time, the risk is lower than what equities are, usually around 25-30% risk that we have seen in the similar time period, rather 27-35% in that range. The drawdown here was only 24%. And also, as I've shown that, volatility, the up and down movements are very large in equities. Here it's a bit lower than what equities would have given you. So in times of stress, still the portfolio, because of the gold advantage that it gets, it would have fallen less. Like in 2008, when markets fell by 50%, gold was up 30%. So the 20% of that engine was working well for you when your markets when your equity, the bulk of your exposure, was not doing well. So I think the 20-80 strategy over the long term really works well. It has worked well in different market scenarios. So you could easily bank on this 20-80 strategy. And I think this returns are enough evidence that it will be helpful to kind of, mitigate that cost of living increase that we have seen. And it has delivered more than that. Plus, it will give you a steady ride rather than banking on one asset class. So it is that magic formula that you were looking for when it came to what asset allocation, how should I be positioned? This is the answer for that. So if you are looking at a very long-term 10-15-year investing and, just investing and not worrying about it, I think this will work, and this will do the hard work for you from an investment standpoint and deliver returns that will meet your financial goals. So if you think that 12-80-20 is the answer for you, we have kind of tried and make it further simplified for you. If you go to our website, there is a module available which tells you where you are invested today, in what is the asset allocation, what is the risk that you have today, and with the 12-80-20, what are the changes that you need to make to convert your current allocation or any further allocation that you want to do into this 12-20-80. So with a few clicks, you are sorted with this 12-80-20 allocation. Anytime you want to top up, you could just go again, how much money you want to put. It will give you a ready-made solution. So it makes your life really easy, and you're sorted to your for your investment journey. So I will just, this is how the actually it works. I will just run a video to show you how it really works. And it is really, really simple, the way it's designed for you. It kind of makes your life really easy. I will. So this is how, when you log in, this is how it will show you your current asset allocation, where you're invested, what are your returns today. And when you want to know more about how to convert your allocation or any incremental allocation towards the 12-80-20, you just scroll down and it's available there. You just enter what is your planned investment over and above the current allocation, or if you don't have any, you can just convert the current allocation to that by putting a 0 there. You enter your monthly expenses. What is your monthly expenses today, so that it tells you what should be your 12 months of allocation to be kept very, very safe. If you put something like 15,000 and how many months you're comfortable with, 12 months, 24 months, 18 months, and you just click on calculate, it will show you your current allocation and it will show you what should be your suggested allocation to kind of ensure that you are well allocated in a 12-80-20 solution. So the blue bars are the equity allocation, the yellow bar is the gold allocation, and the pink bar is your debt allocation. And overall, it will tell you what is the total today, how you're invested, and what will be in the future, and what is the kind of returns that you can expect. Your return today or from a suggested allocation can be lower than what you are, or it could be higher. If it is lower, for sure, it might be taking a lower risk than what you have taken today. Always remember this, that when you try to take a higher risk, that does not guarantee a higher return. But if you want to take a higher return, you have to take a slightly higher risk. So if you have generated a higher return, that could be because, say, some market timing, or it could be because you have taken higher risk. If the returns of the suggested allocation is lower, then probably you might be taking a lower risk than what you have taken today. And this is something that has worked from a risk return perspective. So overall, it is really simple. With a few clicks, you can get yourself sorted to an allocation or a formula that has worked well. So I'll encourage everyone to just go on our website and try to use this allocation module. You can play around it in terms of how you can customize it for you in terms of your expenditures, how much you have, how much months of safe money you want to be, and it will help you to make your investing journey really, really simple. So with that, I come to the end of my presentation, and happy to take any answers on the 12, 20, 80, or a customized or a ready-made solution, or anything that you want to know about asset allocation for 2022, or our views on any asset markets. Thank you so much. Or back to you, Sandeep.
Yeah. Thanks, Chirag. A wonderful way to start the year on the right asset allocation. We will take the question answer that because there are some questions in the chat box right now.
Sure.
And this is the question many of the investors would like you to answer. In fact, you must have seen there has been silver ETFs in the news. In fact, so what's your view on silver ETFs?
Yeah, sure. So silver, if you look at within the asset allocation, right? Apart from this 12, 20, 80, there could be something on the top, say a 5% allocation, which we usually call it as play money, which is nothing but, tactical allocation. If you think that something is doing well, you should have some allocation to that. So maybe small tip on the tip of the allocation bucket or this kind of chart, a small 5% you can carve out for that play money. And I think silver, the green top that you see here, I think silver is meant for that. I will tell you why. Silver, after getting delinked as a form of money, at one point in time, like a precious metal, it was also used as money like gold. But I think it got delinked way back. And much of the usage for silver comes in industrial uses, like electronics, incrementally today in solar panels. So it is more an industrial usage commodity rather than being a precious metal. If you look at central banks across the globe, hold gold and not silver in their forex reserves. So that really tells you that it has got delinked as a form of money, and it is more industrial commodity. An industrial commodity will do well when your overall economy will do well, when the demand of things are going higher. That is why when usage of electronics, etc., starts increasing, and therefore demand of commodities like silver will keep increasing. So when economy does well, silver is likely to do well, and even your equities are likely to do well, right? Because they are also linked to economy, and it gives you a similar exposure to what your equities will give you at the end. That is exposure to higher economic growth. So, so in a way, it doesn't fall within the diversification bucket like gold does, because gold usually does well when equities are not doing well, when economies are not doing well, and that is when gold is bought more, and that is why gold does well. So, so silver is not a diversification tool. So, if I am carving out 20% for diversification, it is not, though there is a high correlation between gold and silver, but time and again, in each of the crises, be it 2008 crisis or the COVID crisis, gold did much better than silver. So it tells you that gold is an effective diversifier as opposed to silver. And silver, if you think that demand for silver is going to increase significantly and it will outstrip supply. So from a demand supply imbalance, you could take an exposure to silver, but it will not fall in that 20%. It will fall in that 5% because it's a tactical exposure, not a strategic exposure of your portfolio. So, so treat silver as, if you think demand supply imbalance is going to cause silver price to increase, or the price has got depressed currently, then you could have exposure to silver, but not as a diversification tool, but as a tactical allocation. And you have to be very thorough when to exit that, because it goes through cycles. It is very, very volatile. Silver can go up and down 20% very, very easily in a short span of time. So you need to keep that into account when you're participating in that market. Unlike gold, which is more steadier, silver is very, very volatile. So you need to keep that in mind. So so today, I mean, if you think that the increase of solar panels will drive, say, demand for silver, and therefore the price of silver will go up, then probably you could have some participation there. But again, you need to ensure that in a commodity world, if the prices keep increasing significantly, there are substitutions that come which will kind of derail what you're seeing today. So we have seen, like, for example, in the auto industry, right? Platinum is used in auto exhaust systems. Today, when we move towards EVs, those users of platinum will decline significantly because EVs are not polluting, and therefore the usage of catalysts to kind of reduce pollution is not there. And platinum prices can come under pressure, have been under pressure because of that move that we are seeing. Similarly, for silver, if there is a, say, a substitute for silver in solar panels, then probably the demand can take a big hit, and prices may go down. So you have to take demand supply where the price is today, how much it is factoring that demand supply imbalance, and if there are substitution possibilities for that kind of commodity or not. So silver, not a diversification, it's a tactical allocation, it's a commodity that you can play in terms of prices.
Thanks, Chirag. Many investors would have liked to listen to that. We had this question coming in previously. So there's another question from one of our investors. He had invested in ESG fund. The TR of ESG funds seems a bit high compared to other AMCs. So first of all, is it high? And secondly, are there any plans to reduce the TR charges? And also, if you can brief on the roadmap of quantum mutual fund on the expense ratios that we have.
Yes, sure. So a couple of years back, we had given a roadmap. I think we were the only AMC to give a roadmap of reduction in expense ratios as size increases. Even for ESG, we'll follow a similar approach. As our size increases, we'll pass on the benefits. Today, we have our own internal team running ESG since 2015. So we have been working on it big time through our internal team. We have a proprietary ESG assessment methodology developed, a proprietary framework developed on measuring companies' ESG since 2015. So we do it all internally. Research is our forte, and we take pride in building our own proprietary frameworks as opposed to relying on third parties to give us research. So we have a good big team on ESG as well, a separate team. So that also entails a cost. And you could see that, in terms of the ESG research that we do, and that is what differentiates us and will differentiate us over a long time period. So as our fund size grows, we will surely look at reducing the expense ratio, and very soon we'll give a roadmap on ESG fund as well. But for other funds, it's available on our website. There is a roadmap out there in terms of how the asset size increases and how our expense ratio will go down for each of the funds. And very soon we'll put that out for ESG fund as well. We are waiting for a 3-year track record, which will give us more confidence. And thereafter, we'll put a roadmap for reduction in expense ratio for ESG as well.
Thanks, Chirag. Chirag, what are your views on Nifty Alpha ETF funds?
Nifty Alpha, if I understand that correctly, it is from the Nifty bucket. You bank on certain stocks within that basket. You change the weights of certain stocks that you think will do well, and therefore try to create an alpha over and above what Nifty will give you. So there have been products, they are called smart beta products overall. We have seen, beta, they call it smart beta, but beta is rarely smart, because we have seen time and again in various, because models work till they work. And whenever we have seen that many of the funds launch in markets abroad like US, etc., which have been pioneers in these kind of things, rarely we have seen, or very few funds have kind of succeeded in those kind of strategies. We had one in our Indian market also long back, and they kind of changed or modified that fund to a simple Nifty 50 ETF because that was not working well for them. So be wary of such kind of strategies. It will be better to keep your investing simple. Nifty itself is giving you good returns over the long time frame. We believe that active investing can still work well, and you will see that so far over last 10 years or so, we have been in an easy liquidity market, barring a small time period in 2017, 2018, when Fed tried to unwind their balance sheet and reduce liquidity, but that didn't last for long. There has largely been an easy money scenario. Now, if we see tightening, if we see inflation, I think there could be a time when strategies like value or strategies like active investing overall may start doing well. So overall, I think you need to keep it simple if you want to participate in such kind of alpha Nifty ETFs, I think it should be part of that green triangle on the top, which is like a 5% allocation within that, and not more than that, because seldom such kind of strategies have worked. So you need to be cautious when you participate in such strategies.
Thanks, Chirag. Chirag, whether Quantum is going to come up with any new fund offers also, and just for the benefit of our investors here, you can also tell them what is the philosophy of Quantum in launching new funds.
Yeah. So we try to keep the investment very, very simple. We want to keep it simple because you could understand that, you can understand and appreciate the risk and return characteristics of that investment, and there only you should participate. That is our belief. From a new offering perspective, you would have seen that we have filed for a Nifty fund of funds because it makes it easier for investors to do an SIP, and without any demat account, you can participate in the Nifty. We still believe there is scope for active investing to deliver over the long run, but you could create this 12-80-20 kind of thing in a passive version as well, if you like, if you wanted to further simplify. And to help that, we are kind of launching that Nifty active, not Nifty active, Nifty fund of funds, which will invest in the Nifty ETF to help all those who want to build a strategy, do an SIP without an demat account, invest in that. To facilitate that, like we have the gold saving fund, we are launching that Nifty fund of funds. Alongside that, we are working on some strategies as well. So we will come and brief you very soon on that, because we are very research oriented. We think that if something works well from a research perspective, we have the ability to add value, and something that will complete your investment bouquet, not a replicate product, not something that you won't require. We will not launch any kind of such kind of funds, but only which we think will add value to your portfolio, anything that will help you to allocate better, fulfill a need that you have from your investing. That is the kind of funds that we will launch. So we'll always keep it simple. We will not be like not be rolling out funds every now and then. Only when we see a purpose, only when we see a need, that is when we will launch a fund. So we are working on one of the strategies, or a couple of strategies rather, but they are in the works today. And once we kind of have confident on our research process there, we will come out and tell you all.
Thanks, Chirag. Chirag, is the question from one of our investors, Mr. Vivek Jindal. No, it's an FY 1920, the Nifty was down around by 25%. So the question is whether it is not better to invest in quality companies in this kind of opportunities rather than investing into gold and a debt, which may drag the returns.
Yeah, so if there is an opportunity in market, again, I will say that whenever you put money in markets, I think you could calibrate on such opportunities whenever there is a big fall in market and you want to allocate, because those are the times when we see there is already an imbalance within your portfolio. So you could try to take advantage of those opportunities and kind of build buffer on asset markets that have fallen more. Like, for example, equity had fallen by 40% and gold had not fallen much at that point in time. It was steady at that point in time. So it was an opportunity to take money off gold and put it into equities and rebalance your portfolio. So you could still had that 20-80, but given that your 80 would have fallen, say, to 60, you could have taken 20 from gold and put it into equity to rebalance your allocation and also take advantage of the opportunity that the market was giving you. So I'm not saying that you should not utilize such opportunities, but still within that 12-80-20 construct, you can calibrate on such opportunities by rebalancing your portfolio allocations. And that is exactly what you're saying. Why should I not take advantage of the opportunity and still keep money in debt and gold? But don't forget that they were the rescuers during that time, and they were kind of held their value. So your portfolio didn't fall much. But at that point in time, if you think it was opportunistic, you could have taken money from debt and gold and put it into equities and rebalance your portfolio a bit. So you could do that for sure. and you should do that as an investor. So probably within this overall scheme of things, we will kind of try to see if we can, build something that could help you rebalance, or we could guide you to rebalance during those times. So we want you to build this 12-80-20 construct because it has worked well. And those rebalancing, we will work out something that could help you to do that more efficiently and enhance your portfolio returns. So we should hear something very soon from us in terms of how we could help you further in your investment journey on the 12-80-20 formula and use market opportunities to your advantage.
Thanks, Chirag. Chirag, on the multi-asset fund, now multi-asset fund has a taxation similar to a debt category fund, right? So if you are investing in a multi-asset fund for a long term, there may not be a tax benefit, or the tax may eat up into the returns, or for a person who is in a higher tax slab. Now, how will this fund help this investor? Should the taxation part be a concern on this?
No, that's not at all a concern. Rather, it's just to your advantage, right? If you're doing, say, a FD, you're straight away paying a 30% tax if you're in that 30% bracket, if you're in a high tax slab. But if you're in a multi-asset fund, if you stay invested for 3 years or more, firstly, whenever we are changing allocations within that, there is no tax. If you do it on your own, there is a tax. Secondly, after 3 years, the tax is 20% with indexation, which means that it is 20% with indexation. So the net tax comes to somewhere between 8 and 12%, depending on the indexation benefits that you get, because indexation numbers change depending on the inflation usually in that particular year, and it gets announced by the government. So depending on the indexation number announced and the benefit that you get, therefore, your net tax comes to 8 to 12%. And this 8 to 12% is compared with your 30%, right? So it is really advantageous for you. So any gains that you generate, you end up paying net tax of 8 to 12%, and on your FDs, it is 30%. So it is really advantageous for you from both these points. One is any rebalancing or any change in allocation, you're not paying tax at any point in time. Had it been doing yourself, you would have paid tax each time when you increase or decrease the allocation. And secondly, your 30% tax comes to around 8 to 12% tax. So it is really, really advantageous. It is a myth that, being treated like a debt fund, it is onerous or it is disadvantageous for you. Rather, it is very, very advantageous because your tax really comes down significantly.
Yeah. So there's a question on Insta redemption. You mentioned on Insta redemption.
Yes.
How does the Insta redemption order is to be placed? So for benefit of all the investors, I would like to tell the Insta redemption presently with Quantum is available on Quantum Mutual Fund's website. You can log in your invest online section. There is an icon on Insta redemption. You can click and the amount should be below the 50,000 rupees, and the amount will be in your account in the next 10 minutes. So
it's similar to your normal redemption. There is a button for Insta redemption. You just tick mark that, and immediately that 50,000 you can withdraw in 10 minutes. It will be in your bank account, be it any point in time. Even if you're doing at say 8 o'clock at night, beyond the cutoff hours, any point in time, you just select that option of Insta redemption, and 50,000 if you need for any emergency, it will be with you at within 10 minutes.
Thanks. Since Chirag, you were explaining about the taxation part in multi-asset also. So it's a similar question for fund of fund. What is the taxation if someone exits before 3 years in our fund of funds?
So if you exit before 3 years, then it is taxed as per your tax slab. It is taxed if you're in a 10% bracket, it's taxed 10%. If you're 30% bracket, it gets taxed at 30%. But the main real advantage of investing in equities is to benefit from the long-term returns that equities generate. And therefore, a minimum 3 to 5 year period should be the minimum that you should be looking for. I think it should be much higher, but the minimum should be at least a 3 to 5 year. And beyond that, the advantages kick in. After 3 years, it becomes 20% with indexation, and therefore your net tax comes to 8 to 12%. And any changes that we do in the portfolio, any scheme changes, we move from fund A to fund B. If we exit fund A and go in fund B, you don't end up paying any tax. Whereas if it is your personal portfolio, you still end up paying tax. So that is again an advantage that you get with such products, though it should be taxed as an equity fund given the underlying being equity funds itself. But the rules don't allow it to be taxed like an equity fund. But still, it doesn't be very, very disadvantageous for you if you include or club both these benefits. One is any scheme changes, no taxes. And second is after 3 years, net tax boils down to 8 to 12%.
Makes sense. Chirag, one of our investors would like to have a comparison link. Quantum mutual funds, fund of fund, and you also mentioned about alpha ETFs. So first of all, is there a comparison between the two funds, or would the funds be compared together?
So I think Nifty 50 Alpha ETF, if that is the fund you're talking about, so the universe is very limited in that Nifty 50 Alpha. If you look at the universe, it will be just that 50 stocks, whereas here it is a diversification across market capitalization. So we have about 6 funds in the large cap oriented category. Large cap oriented, we define it as any fund having more than 60% allocation at all times in large caps is a large cap oriented fund. Any fund which has less than 60% is a non-large cap oriented fund for us from our classification perspective. And so it is a good mix of 6 funds from the large cap orientation and 3 funds from the non-large cap orientation. So it boils down to around 60-40 or 30-70 kind of portfolio to large and mid caps, whereas Nifty 50 Alpha is strictly large caps because it is in the Nifty 50 stocks itself. So here it is a well-diversified portfolio. It is diversification. It is active strategies involved. It is not passive strategies. It is using the fund manager's credentials. It is using the fund manager's expertise to select stocks and be in the right places at all points in time. So I think equity fund of funds is more advantageous for you. And that is why in the whole scheme of things, we are allocating 70%. So this 70% is money that we are investing on your behalf to external fund managers. It is not remaining with us in the quantum mutual fund. We are taking that research-backed call to allocate on your behalf to these 9 funds in the portfolio. So overall, I think it is more broader, more diversified across market caps, across styles, and therefore I think it is much better allocation as compared to the Nifty 50 Alpha ETF.
So Chirag, there's a question again on fund of fund, equity fund of fund.
Sure.
Equity fund of fund has around too many funds. The question from the investor, it has too many funds. As on, if you see our December fact sheet, there is around 9 funds in presently in our fund of fund and around 10 to 11% exposure to each fund. The question is, it has a higher expense ratio of 0.75. So that's the regular plan. The direct plan, we have around 0.5. That's the expense ratio. So the question is, if can we have a next 50 index fund instead of 3 large cap funds in that fund? And when most large cap and mid cap active funds do not beat their indexes, so this may, if we have a passive fund in that or Nifty fund in that, it may reduce the amount of expense ratio also. So what's your view on it?
So we still think the theory says, I mean, we still believe that, active fund management over a long time period will still do better than the passive. In Indian markets are still not that mature. There is still inefficiencies, and therefore over a long period, active should do better than passive in a way. And you are looking at one phase of the market. We talked about recency bias, right? So over last few years, passive investing has increased significantly. The flows from EPFO or other institutions has been largely on the passive side. So there has been, a self-fulfilling virtuous cycle of passives doing well. But again, it was an easy liquidity scenario. Interest rates were low or falling. So that has helped passive a lot. But doesn't mean that active may not do well. So overall, still there is scope for active to do well. And we are trying to pick up fund managers' expertise in trying to navigate markets. So it's not only about returns, it's also about the risk. Active fund manager looks at governance, looks at various other things, looks at management quality, etc., while they take the call. Whereas Nifty 50 or a passive allocation does not look at those risk that could be present in a stock. So overall, I think there is still merit to go towards active investing. And if you look at the expense ratio that being talked about, of course, passives are available at much lower cost. But here, 0.51 for all the research that we do, there is always a scheme running expenses to be paid in terms of the custodians, the R&D agents, etc. So there is a minimal scheme running expenses involved, plus all the research that goes into selecting of funds is also leading to that. So it's just a 0.51 expense ratio that we charge. Plus, if you look at the underlying funds expense ratio, that is closer to 0.7%. So in aggregate, it becomes 1.2% in total. And I think even after the expense ratio, it has generated decent rates of return for investors. So don't look at the recent phase in comparing with passives. I think over a long time period, it should kind of start performing better than the passive. There was also a polarization in the market that we saw that drove passive performance as opposed to the active. Active is more diversified. If you look at the BSE 200 index itself, the top stock is about 9 to 10% of the index, whereas the top stock in the equity fund of fund portfolio, if you do a look through portfolio, it weighs about 6%. So it really tells you that it is well diversified. Even at the top 10, for the indexed BSE 200 is about 44-45%, whereas for the equity fund of funds, it is around 34-35%. So it is well diversified as compared to the index as well. And when in times of polarization, concentrated portfolios like the indexes may work better as opposed to the diversified portfolios. So I think don't go by the recency that we have seen. If you look at the long time period, it will still be the indexes. So we will want to be with the active management at this point in time, unless we feel that actives will not do better than the passives. At that point in time, we'll come back to you and say that we will not shy away from telling that we should move towards passive and not be with active. So until then, I think we will stick with the portfolio. And when it came to the number of funds, we had 7 funds in the portfolio until last year. We increased it to 9 funds because we have seen that many funds go through their cycle, though they have been good long-term performers, but there could be some cyclicality with the style in which they invest. And that was at a 14% allocation that was having a significant impact on the overall performance, even there was a small underperformance from any of the fund. And from a consistency perspective, as I said, that today's top doesn't remain tomorrow's top. There is a cyclicality involved. So we kind of, in the interest of investors to get a steadier return and not let one fund return overtly impact overall returns that you get, we increase that size from 7 to 9 funds. So it is done after thorough research. It is done after thorough homework, number crunching, and it worked in the interest of investors, and that is why I increased it to 7 to 9. When we keep reviewing our process, and when we think that it is time back to revert to smaller number of funds, we will also do that. So we have kept the window open for 5 to 10 funds, and to navigate between that, whichever is in the best interest of investors. So for now, it will be 9 funds given the scenario that we are seeing. But in the future, if it merits that we should reduce it, we'll surely reduce it on your behalf.
Thanks, Chirag. Chirag, is a question on multi-asset. Now, multi-asset may seem a bit of a conservative fund for some investors. Investors with most of your 50% of the funds placed in liquid funds or debt in excess. So is there any scope of rethink, and also for benefit of investors, can you just brief on philosophy of multi-asset? Why is it needed? For whom it is? Yeah, so the endeavor is very clear. We want to generate higher return over a time period more than your fixed deposits, and at the same time take minimal risk. So if there is a risk present out there in terms of valuation, we will refrain from taking risk. So it is a well principle based allocation process that we follow. Whenever there is whenever there is a risk, we will not participate, and that is how we've constructed the fund to give us enough flexibility
to navigate a particular cycle by underweighing and overweighing an asset. At the same time, if there is an opportunity, to grab those opportunities. For example, last 12 months or last 1 year or so, we had been very, very patient given the run up that we are seeing continuously in equity markets, and they're trading at very high valuation. We were at the lower bound of our equity allocation at 25%. March 2020 gave us an opportunity. We were at 25% before that COVID crisis hit us. We increased that allocation from 25% to 50% in that just 1 month. So whenever there is an opportunity, we will grab that opportunity. Whenever it doesn't make sense to risk your capital, we'll stay lower allocated to equities. So if there is a risk, we will not participate. If there's an opportunity, we'll grab it with both hands. So that's the approach that we have. At the same time, the endeavor is simple, to give you better allocation to your better allocation than your fixed deposits. So if your fixed deposits is giving you, say today a return of 6%, our endeavor is to give a higher return than that over a 3-5 year period, and ensure that we stay more days above a fixed deposit allocation line on a 3-year basis at least. Like for example, in this graph on the right hand side, we are 90% of the time better than a fixed deposit. So you as an investor would have been better off being in a multi-asset fund and would have generated a higher return than a fixed deposit 90% of the time. So that's the endeavor. Today, investors have to move out from fixed deposit because that's a losing proposition, and be into a multi-asset fund, which gives you a smoother ride in terms of your investing journey, gives you a steady return, not much volatility, but at the same time, our focus on risk and take opportunities whenever they arise. For example, in the month of December, we saw markets correct sharply, and with the earnings picking up for corporates, the valuation became slightly sensible. So we kind of increase our allocation from 25% to 30%. So whenever there is an opportunity, we will not shy from taking those opportunities. But whenever there is a risk, we will not want to risk your capital. So that's the whole philosophy that we kind of work. And on a 3-year basis, it is also tax efficient as compared to your FDs. The FDs, if you're a 30% bracket, they're taxed at 30% no matter the time horizon. Here, when you stay, most of us kind of book 1 or 3 year FDs and we keep rolling over. So if you are in a FD with a horizon of 3 years or more, it becomes really tax efficient because your net tax comes to around 8 to 12%. And whereas in your FDs, it is 30%. So it is really, really very good if you want to have a horizon of 3 years or more. Plus it is liquid, right? You want money any particular day, you can take it. When you break your FDs, you have to pay penalties, etc., which kind of hurts your return further. So overall, that is the construct that we have for the multi-asset fund. So if you're looking for an alternative to your fixed deposits and have a multi-asset approach and a 3-year plus time horizon, I think that is a place for you to be.
Thanks. Thanks, Chirag. Chirag, we talked about asset allocation. We also talked about fund of fund, which primarily invests into domestic mutual funds. But there's a question from that: why Quantum doesn't have an exposure to foreign equities? Shouldn't be international funds be a part of your allocation in anywhere?
So we are not averse to having international exposure if some of the fund has an international exposure, some portion of the portfolio, and large portion in domestic companies, then probably that could be a part of our portfolio. We are not averse to that, but the idea is that bulk of your exposure is still going to be in Indian equities, and there are so many schemes out there that give you exposure. So from a investor standpoint, what is the solution that you could have a ready-made process-oriented fund which gives you exposure, selects good schemes on your behalf? And so that was the idea behind the equity fund of funds. We do agree that within a portfolio, you can have a small allocation to a global equity or a global allocation, and that should be there in a portfolio. So what kind of exposure you have, you could trim out the gold or the equity exposure within your basket. But we do agree to the thesis that there could be a global global exposure within the overall scheme of your portfolio that you construct. So you can have that exposure. Today we do not have an offering, but if we kind of click the right idea, a research back process to have a allocation within our bouquet of products to a global investing, we will surely launch it, because we believe that you could have a so we don't have it within the equity fund of funds. It would be a separate allocation. You have to look at it from a separate allocation perspective. But within the equity fund of funds, if a fund has some global exposure, we are not averse to having it in the portfolio. So that's our call.
Okay. A continuation on the same we as investors also do not see a balanced fund in our allocation. So is it really necessary presently that in our allocation which we should?
Yeah, so balanced fund, I mean, when with this formula of 12-80-20, you're creating a balanced fund of your own, right? In some perspective. So that is what we believe is better. The balanced funds out there, if you're talking about the normal balanced funds out there, they are kind of having a minimum 65% allocation to equities. They're lopsided towards equities. And therefore, in our view, they are not balanced funds. So multi-asset is more balanced, though it is conservative, but it is still more balanced, because debt and gold allocation both range from 25% to 65%. So that is not lopsided to any particular asset class, gives us enough flexibility to reduce risk and grab opportunities when they come. Whereas even if the fund manager for a typical balanced fund, which is 65% equities, does not like equities because they are very richly valued or very high value, they will not be able to reduce their allocation below that 65%. So in a way, they are not able to mitigate the risk when it really matters. Having a 65% allocation or having an 80% allocation, I think the characteristics will broadly be the same. So I think as compared to a typical balanced fund, I think multi-asset fund is better, or rather better, do it yourself in a 12-80-20 strategy and construct your own balanced fund rather than having a lopsided exposure to a balanced fund, which will not be able to reduce risk when it really matters.
Yes. Chirag, coming to gold funds. Now, current year we saw a depreciation in gold value. If 2000, the question of our investor is, if 2022 continues like last year, so do you still see the benefit by investing in gold funds? And also, can you, for benefit of all, also understand the TRs also of gold fund?
Sure. As I've said that, every asset is there for a portfolio, right? You might have a view that, we are on a cusp of our economic revival, and therefore equities is the place to be, right? What happens if, say, COVID stays us with further, there are mutations and, it kind of rages further, or if there is an inflation which kind of just moves out of control, like we saw in the 1940s or 1970s, what if such kind of scenario plays out? Then there are risks to our equity investment as well. So you might have a view, but you don't know what are the risks that could come from anywhere, right? COVID was something no one predicted, but it still came. So you could have a bulk of your exposure towards the asset where you think the probability is higher for that scenario to play out. But gold is always an asset which is a diversification tool. Not all assets in the portfolio are for return generating purpose. They are kind of steady, generate like a 10% return over long term is not bad for an asset like gold, because it comes useful at times when your equities are not doing well, when your bulk of your exposure is not doing well and need money. Something like gold can come to your rescue, and you need not sell asset at a 50% value, and you could sell asset which is up 30% in that year, and therefore help you during those times. So it is like a second engine of your airplane. If first engine fails, there is a second engine that comes to your rescue and help you land safely during that time. So you need to look at from a portfolio construct perspective and ensure that you don't get carried away by the forecast that you see around, that it is likely to be good years for equities because economy is likely to move up. But there could be risk or uncertainties that could come from nowhere. And therefore, you need to have allocation to all asset classes. Today, gold is not doing well. 2020, when equities fell, gold did well. So you need to have allocation to all rather than choosing an asset class depending on the view that you have, because view can change significantly in a short span of time, and you will not have enough time before you kind of say that, you know, I should have had some allocation to gold. So always have a good allocation, because as you saw that chart, 90% of the variation in returns from portfolios emanate from asset allocation, and only 10% is other things. So have an asset allocation. That is what I will suggest, and you will not regret that decision. Coming to the TERs of gold ETF, our TER for the quantum gold ETF is 0.78%, and quantum gold saving fund is 0.06. So if you are in a quantum gold saving fund, effectively pay 0.78 plus 0.06, so it is 0.84% of expense ratio that you pay. Bulk of this money goes towards safekeeping of gold. It is stored in professional vaults. It's not the similar locker that you have, you know, for in your banks. It is a specialized locker facilities that, you know, are managed professionally. Plus, it is completely insured, so we don't compromise on insurance. It is even includes terrorism insurance as well. So it is very, very comprehensive insurance that we have. And as our size increases, we'll again look at lowering the expense ratio. We did lower it. We were at 1%. We brought it down to 0.78%. Again, as the size increases, we'll further look at lowering down and pass it on to you. So this is the expense ratio. Again, we have a roadmap to kind of reduce it as the size increases.
Chirag, like in our asset allocation, we showed 20% on gold. So yeah, the question from the investor is that would you like them to invest in gold ornaments or an ETF or a gold savings fund? Does it make a difference? As Indians, we are surely very fond of gold.
Yeah, sure. So I think anything for consumption is not an investment. Even if it is a house, it's not an investment. If you have a second house, it is an investment. If it is for usage purposes, if you buy jewelry, it is for usage purposes, and that's not investment. And as an investment, jewelry is one of the most inefficient forms of purchasing gold. There are making charges, there are markups over the gold price, and concerns on purity. When you sell it back, you kind of lose out on GST. There is a melting charge associated with it when you sell. So from that perspective, I think it is very, very inefficient form of buying gold jewelry as an investment. Earlier, there were restrictions on purchase of gold. Only at some point in time, only jewelry was the form allowed in India. So there hasn't been a habit of buying gold in jewelry form, right? This was an era where efficient products on gold were not available. Today, you have various efficient products on gold that give you a really good efficient price. Just imagine you are buying 0.01 gram of gold at a price when nearly where the wholesalers, like I'm talking about a gold producer and a gold bullion bank transacting tons and tons of gold, similar at those similar prices, you are able to buy 0.01 gram of gold. So that's the efficiency that gold ETFs and gold funds bring from a wholesale level to a retail level. And so it is very, very efficient. Plus, you don't have to worry about storage. You don't have to worry about purity. You don't lose out on GST offset. So from all these perspectives, I think it is become very, very efficient. And therefore, 20% of gold should be in efficient products, not in inefficient products like gold bars, gold jewelry, etc. It should be gold funds, gold ETFs, sovereign gold bonds, or sovereign gold bonds, even if you believe that, because they are not backed by gold, whereas gold ETFs and gold saving funds are backed by gold. They are backed by a government guarantee to make good on the gold price. So they do not buy gold. Here we buy physical gold, 24 karat gold, and store it in professional vaults, and it is insured. So depending on what kind of efficient form you choose or you believe in, you have to be with that form, and please avoid gold inefficient forms as part of your investment strategy.
Thanks, yeah. So Chirag, on the screen, I can see two questions. In fact, it can be more of a coincidence. So one is, One is, should be crypto as what's your view on crypto should be used as a hedge to your portfolio? And the next question is, what is play money?
Sure. So I think both are very related, as you said. Cryptos does not have any intrinsic value, right? What is the value for crypto? Where does it come? Just because it is limited in supply, does that make it a good currency? They are touted as an alternate currency to dollar, rupee, etc. But what here the governments have the ability to tax, and that power gives currency the value, right? They can tax, and therefore that gives them revenue, and therefore the currency has some value. So they have an intrinsic value along with it. But what is an intrinsic value? Today, there are thousands of cryptocurrencies, more than thousands. And every other day, we see some or the other launch of a cryptocurrency. How do you differentiate between cryptocurrency? Tomorrow, I'll launch a Chirag crypto. Does that make it a currency? Will you buy it? If not, then why are you buying other cryptocurrencies? How does they derive value? Right? So overall, I think cryptos don't have intrinsic value. Firstly, we have seen a tulip bubble in the past, where tulip flowers were kind of bought and sold, and it was a big bubble that kind of happened. It also didn't have any intrinsic value, though it was something physical at least. But cryptos are just on machines. They can be mined. It requires a lot of electricity to mine cryptos, and they just get an ability to, because of that limited supply assurance, they kind of get that benefit of being touted as currency, but they are not. And so I will suggest, or my opinion is, or my belief is, one should not participate in that. Play money is some portion of your capital that you can use for tactical allocation, something you believe in, or something that you want to speculate on. Those kind of things that could be there as your play money, but that should be like 2 to 5% of your portfolio, not more than that. You should very ensure of strict budget line on that allocation. Usually what we have seen is most of the people invert this pyramid. The play money becomes a big portion, or the big underlying bone of your portfolio, and most of the important things become as small as play money. So many investors get this completely wrong and have it inverted. But please ensure that you don't invest more than 2 to 5% of your capital in play money. That could be anything. That could be a tactical allocation, that could be a speculation, that could be cryptos, or whatever you think that you should allocate to. But something that you can afford to lose, something that you think that if even it becomes zero, it will not matter to me. That is the money you should allocate to play money, and nothing more than that, because that's a pure speculation, pure game that you're playing, and assuming that it would get lost and still not affect you. That is the amount that you can allocate to play money. And I think even if you participate in crypto, which I don't believe in, but still, if you would like, it should be part of that play money.
Thanks, Chirag. Now, Chirag, this is a question from one of our young investors. His name is Suresh. He saw your slides, and he thinks that to double your money takes around 9 years. So as a 25-year-old,
sorry, what takes 9 years?
To double your money.
Yeah.
Double your money. It's around 9 years. So, and he's 25 years old. So what's your advice? What should be his expectation, and how he should go about his portfolio?
Yeah, if you're young, I think for any age group, I think if you are looking at having a long-term time horizon, this 12-80-20 has worked well. And even for a young person, equity allocation has to be a big chunk of your portfolio. If you look at FDs, take 9 years, and FDs have been a losing proposition that we have seen, right? If you look at equities have compounded by 15-16% over long time frames, right? So it takes much lesser time to kind of double your money in an asset class like equity. But equities again been volatile. Again there is a downside, could collapse by 30-40-50% at any point in time. So you have to have that diversification, some stability. something uncertain that happens to your cash flows, to your job, or a medical emergency, etc. So you not have to affect your portfolio. That is why we suggest an emergency corpus, and thereafter any money left should be big chunk towards equities and a small chunk towards gold. So 80-20 in that split. And this has worked wonderfully well for many age groups, across time frames, across market cycles. So you could just adopt this right from a young age, and I think you will not regret that decision. This is the magic formula that will work for you.
Chirag, is the question on multi-asset now. The current trend seems in an upward market seems. It's more of multi-equity categories in the market. It's multi or a flexi cap with a multi-asset fund spread across different classes in the market. Now, we have also seen several NFOs launched by several AMCs. Given this scenario, a multi-asset fund category would score above it. Should investors because investors, as you said, tend to follow a herd mentality in dumping money in such multi or flexi cap only rather than multi-asset. And given also, if you say the AUM of multi-asset has been on the lower side, so what are your views on that?
You're talking about the quantum multi-asset.
Yeah, multi-asset fund, yes, yeah, visibly.
So in the quantum multi-asset fund, the idea is simple. The idea is to diversify across asset markets, ensure that you are in a bucket where valuations are not onerous. Valuations, if equity valuations are high, that means that it is risky a bit, and therefore you should refrain from having a big exposure there. So it is mapping exposure to the valuation of asset classes, and being in a asset class which is kind of less risky at that point in time. So if you look at the current exposure, we have about 30% exposure to equities, about 55% exposure to debt, and about 15% exposure to gold. That is our exposure today. And within the equity bucket, it is also well split between the three styles of investing: Nifty ETF, the value strategy, and the ESG strategy. Nifty will, because we don't want to take overtly big style risk as it comes along with the value and ESG. So a big chunk is in Nifty ETF to get that allocation exposure right. And also, if you look at the value and ESG funds, they are positioned well to take advantage of the upcycle today, given the portfolios being shaped today. So overall, I think it is well balanced in terms of allocation to equities, and also well balanced in terms of diversification across styles. So I think it has. So if you look at the Nifty is largely a large cap exposure, value and ESG do not have any biases towards market caps. They are kind of across market cap styles, biased towards liquidity. And if you look at the ESG fund, it has about 20-25% exposure to mid caps as well. So it is kind of well balanced across styles also. And if you look at the run up in mid caps that we have seen, it is much more than what we have seen in large caps. So there is, from an valuation standpoint, they are a tad expensive as well today as compared to the large caps. So currently the multi-asset exposure looks well and looks well poised to take advantage in the right manner and in an appropriate manner, being cognizant of the risk that emanates from the high valuation that prevail today still.
Chirag, would you like to reiterate this question? You answered this question. Why does quantum long-term equity fund doesn't take exposure to foreign equities? You did answer this question, but for
long-term equity value fund or quantum equity fund?
Quantum long-term equity value fund.
So quantum equity value fund invest in only in Indian equities because we do not have that expertise to kind of evaluate global stocks today. Our research team is largely focused on evaluating Indian equities, and that is what we think the mandate is today for us. So we will continue to look at Indian equities only in this fund. If we want a global exposure, we will try to come out in a different fund or an avatar rather than doing it in the same fund, because same fund, you have relied on the track record of investing in Indian equities, and the track record is based on that. we do not want to alter that and give you a different fund altogether in the fund, so that your evaluation becomes bit uh, a bit different, because it kind of starts a new track record from now on. So we think that although global allocation is needed in a portfolio, but we think that there should be a separate space allocated to that and not to be mingled with your Indian equity exposure. So we will continue with the Indian equity exposure in the long-term equity fund. And if we think that we have a research capabilities and a process to invest overseas, then we'll come up with a separate product on that.
Yeah. Chirag, can you just reiterate our strategy on 12, 20, 80? Because in the chat box, I can see people would like to see the and the percentages allocation into each fund.
Sure. So 12, 80, 20 is a very simple strategy where you have, say, if your expenses are, say, 50,000 a month, then 12 months of expenses will make it a 6 lakh rupees. So 6 lakh rupees or 12 months of expenses, whatever it works out to be, has to be in very, very safe place. For simplification purposes, we use a quantum liquid fund allocation, but you could decide what suits you best, what you think is the safest way to put this money. This money should only be used when there is an emergency, when you think your cash flows are not enough, or say you have loss of cash flow, you're out of job, or there is a medical emergency. Times when you should not tap into markets. For example, in March 2020, markets were down more than 40%. That was a bad time to pull money out of your equity bucket, right? And if you had need of money, then probably you could have dipped into this 12 months of safe money or your emergency corpus for the emergency that you had at that point in time. So that 12 month safe money has to be left untouched in normal circumstances, only be used in emergencies. Rest, whatever money is left over, say you have 20 lakhs of corpus and 6 lakhs based on 50,000 expenses goes towards safe money, 14 lakhs should be split in 80 towards equities and 20 to gold. So whatever money is left after your emergency corpus has to be split between 80 to equities and 20 to gold. And gold should be efficient gold exposure products, not your jewelry, not your gold bars. It has to be very, very efficient, because if you're not putting efficiently, you're losing on the returns further when you participate in gold. So that takes about that 20%. And that 80% that goes into equities has to be well diversified across styles of management, across different fund managers. And to get the diversification, we have 3 things identified. Out of that 80%, 70% of that 80% should be in quantum equity fund of funds. So for example, if you have a corpus of say 10 lakh rupees to be put in equities, out of that 7 lakhs should go to equity fund of funds, 1.5 lakhs in quantum ESG equity fund, and 1.5 lakhs in quantum long-term equity fund. So that is how it should be split. Whatever money is to be allocated to equities, 70% of that money in equity fund of funds, which gives you diversification across different styles, across external managers out there, across smart managers out there, across funds that have a good track record, a consistent track record, a research-backed portfolio. So that makes up the quantum equity fund of funds. And 15% towards sustainable investing, that goes towards the ESG fund, and 15% towards the value style of investing, because value fund has been true to label right since inception in 2006. And even today, it spells value. So value style also brings another risk-adjusted return angle to it, and therefore deserves an allocation on its own. So that equity bucket of 80% should be split 70 in equity fund of funds, 15 in ESG, and 15 in long term. You do this, I think that this makes 12 months, 12, 80, 20 strategy, 12 months of safe money, 20 to gold, and 80 to equities. And that, if you follow this allocation with your current money that you have and any incremental money that you will want to invest, I think you will be sorted to kind of navigate all kinds of uncertain environments, all kinds of market cycles and be able to generate return that will help you achieve your financial goals.
Thanks, Chirag. So there is a question again, gold funds are giving negative returns since last 1 year. And on the screen, we can see 20% allocation in gold. So the question from the investor, is it wise to come out of gold and again go back in your asset allocation? And again, we have a 12, 20, 80. Should he have that kind of approach?
See, if you had, say, if you were following this since last 1 year, right, then your 80% allocated to equities would have become much more, because equities have gone like about 20-25% in last 1 year. And therefore it has given that 80 would have increased significantly. So you need to maintain this. Don't look at asset class that are not performed well today. Look at it from a perspective that it adds value when my 80% is not doing well, right? When we tell investors invest in gold, we tell them that when you invest in gold, pray hard that gold falls by 50% the next day. When your 20% becomes, say if you have put 20 rupees, then it becomes, say, 10 rupees, your 80 would have been doing much, much better at that point in time, and will make up more than what you lost in that 20% that kind of went down by 50%, right? So and when your 80% is not doing well, you will appreciate the value that your 20% allocation brings to your portfolio. So look at it from that perspective, because when 80 is not doing well, your 20 will give you that leverage in terms of helping your portfolio tied to those bad times. So when you need money, say for 2008, you needed money for your children's education. Equities were down by 50%. Was it a good time to remove money from equities? It was not. Gold was up by 30%. Would I touch my gold bucket at that point and remove money from that? Yes, I would. And then over a period of time, rebalance it back to 12, 80, 20. But for now, I think you should look at how is your portfolio skewed now, rather than taking money out of gold. You could take some money out of equities probably, because 80 would have become, say, 85 or whatever it has become. You can remove that 5 and reallocate to 12, 80, 20 again, but not take out money from gold at this point in time when it has not performed. Whenever an asset class has performed significantly better, it makes sense to rebalance your portfolio by taking money from where you have, whichever portion of your portfolio has done well. That is what we say that, sell high, buy low, right? So whatever has gone up, you need to sell that. And whatever has not done well, you buy that. So that is where you make money. And that is where the rebalancing thing really works, rather than taking money from an underperforming asset, which is more about chasing momentum. And that may not really work well, because today it has, gone up significantly. What are the chances that will keep going up, right? So I think rebalancing works better. You could have a periodical rebalancing, or you could have, say, that any asset class goes more than like 25%, 30%, 50%. That is the time I will rebalance my portfolio at that point in time. So I think today it will not make sense to take money out of gold and put it into 80, 20, 12. I think let it be the same allocation, or you can rebalance the entire allocation today. In our website, when you log in, it will show you your current allocation, and it will show you what it will be in terms of 12, 80, 20 allocation. And you could easily rebalance with a few clicks. You could do that today, rather than taking money out of gold and putting into equities, or putting it in 80, 12, 80, 20. Rebalance your entire portfolio.
Thanks, Chirag. Since we are on the 12, 20, 80, another question on that. Fund of fund is 70% of the equity portfolio.
Yes.
So also the fund of fund may have a higher concentration of stocks. So how do you manage this higher concentration of stocks in fund of fund? Because fund of fund is taking your 70% of your equity.
Yeah. So let me tell you that fund of fund is not concentrated. It is very, very well diversified. It has about 190 stocks in total across all funds. If I look at all the 9 fund holdings, it is 190 stocks. That really tells you it is very, very well diversified. The top stock is just about 6% in the BSE 200, which is a 200 stock portfolio, again, similar to the number of stocks that the fund has. the top stock in a BSE 200 is about 9 to 10%. The top 10 stocks in the BSE 200, which is again a well-diversified index, is about 44, 45%. Whereas in the equity fund of funds is 34%. So it is not concentrated. It is very well diversified, not at the top, but across the holdings that it has. So that is, and there is an evidence, right? Market was polarized over last 2-3 years, and that is why equity fund of funds didn't perform as much. As we have seen polarization reduce over last 1 year, it has started doing well again. So overall, that really also is an evidence telling you that it is very well diversified and not concentrated in a way. So I think equity fund of funds is not concentrated. It is very well diversified across market caps, across stocks as well.
So Chirag, for benefit of investors, would you like to name the 9 funds in fund of fund presently? So I think we have UTI FlexiCap, Sundaram, yes, Canara Robeco, Invesco, and Canara Robeco, Mirai Asset, Kotak and Axis Blue Chip Bank. This is available on our fact sheet. You can visit our website, and you will now and also you must have received the fact sheets in your email. You can go on Funda, we'll find these 9 funds in that, and also their contribution there.
Yes.
Chirag, is the question on banks banks FD. Now, interest from banks FDs are not taxable up to 50,000. Further, one could link an FD with a savings bank with a sweep in or a sweep out facility. And overdraft facility is also now available with banks about 80% of them. So is it very can't that be taken as an emergency fund, because we are showing as 12 months of emergency fund in a liquid fund? So why can't that amount be taken as an emergency fund, a bank account?
No, if you think that a bank account is safe, or if you think that your FD is safe, you could very well be there. Here it is like FDs, if you have, the overdraft will cost you 2% over and above your FD. So 2% you will lose out again. Again, if you're in a say usually we keep money in a FD and we keep rolling it over, right? And your horizon is usually becoming larger than what we thought for that money. So when it comes to quantum liquid funds, say if you keep it there for a 3-year more, because we generally have such large horizon, the taxation will be 20% with indexation, which will boil down to lesser about 8 to 12%. Whereas in your FD, irrespective of your time horizon, you will be taxed at 30%. So that is one differential that kind of, if your horizon kind of increases, if you don't need an emergency money for say 3 years, you will not touch it. And therefore, there is an element or a scope to make a better tax efficient allocation through a liquid fund as opposed to your bank FDs or your saving bank accounts. So you could keep it there if you feel that is safe. But here, we have just put as a low quantum liquid fund, given it doesn't take credit risk and therefore and money available at any point in time, which doesn't cost you. Whereas in an FD, it will cost you about 2% for an overdraft that you will kind of avail.
Sure. So just for information for all investors, if you go on our website, you will find 12, 20, 80. And as a company, we can obviously advise only on quantum liquid fund, and which is liquid fund where the objective is very clear. It's an emergency fund and safety is the priority. So Chirag, again, can you reiterate your views on a balanced fund and a multi-asset fund? What is the difference between a balanced multi-asset fund of a quantum and the balanced funds in the market?
Yeah, so I think balanced fund in the market, I think more popular ones that usually comes in conversations are funds which are kind of having a minimum equity allocation of 65%. So I think having such a lopsided allocation to equities makes it a little imbalanced. Why we say that is, even if the fund manager does not like equity valuations, he thinks that the equity markets are very risky at that point in time. Even if they don't like the markets, they're compelled to stay in equities at least to the tune of 65%. So that makes it, if I am in equities to the extent of 65%, I might have an equity fund rather than just having a balanced fund. So that makes it a little imbalance. Whereas if you look at the quantum multi-asset fund, it is not imbalanced like those balanced funds. It is very, very balanced. The equity and debt allocation range from 25% to 65%. So both equity and debt have a similar allocation range. It gives us enough flexibility to grab the opportunities and at the same time lower the risk significantly. The multi-asset fund can go up to 25% equity, and it has gone to 25% equities when valuations don't make sense for investors. And at the same time, whenever there is an opportunity, it could grab those opportunities easily. For like March 2020, before that in Feb, we were at 25% allocation to equities. In that 1 month alone, we increased it to 50% to take advantage of the valuation that were available at that point in time that made sense to make allocation to equities. So it is looking at reducing risk with a very balanced approach. Whereas if you were to look at balanced fund, they are kind of lopsided towards an equity allocation. So that is the difference, large difference between the approach that the balanced funds have out there versus a equity multi-asset fund that we have. And I can understand that, you know, most of the balanced fund have a 65% allocation to equities just to get the tax advantage and be classified as the equity tax product, whereas the multi-asset, because of its status as a debt fund, it is getting a debt taxation. But if your horizon is 3 year plus, the taxation would end up nearly very, very close to even your equities over a 3 year period with gains are taxed beyond a certain amount at 10%, whereas this would be between 8 to 12%. So it will be very, very similar beyond a 3 year time horizon, but you get a product which also looks at risk as an element and not just gets carried away by the tax benefits that it would get.
Thanks, Chirag. Thanks, Chirag, for your time. Just a message to our investors. We have been listening now to Chirag. Chirag is your fund manager. In a way, you can be yourself, be your own fund manager, and as a thoughtful investor, you can visit our website for 12/20/80, where you can manage your own asset allocation. It's thoughtful allocation. We will request people to go on the site. Chirag and the Quantum Mutual Fund team is always there to guide you. But you can make your own decisions, and you can use the 12/20/80 asset allocation to plan your portfolio. Yeah. Thanks, Chirag, for the time. Thank you all for giving your time. If you have any questions more, you can write to us. We will surely get back to you. If there are any questions for Chirag or any questions on our 12/20 asset allocation strategy, please write to us. We will get back to you. You can write to us at customercare@quantumemc.com. I again thank you for all of you to giving your time. Thanks a lot. Thanks a lot. Thanks, Chirag. Stay safe. Stay well.
Thank you all. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.